Welcome to G-Fun Facts Online. In the vast, chaotic ocean of global finance, consensus is the force that stabilizes prices, but divergence is the force that generates profit. For decades, manual traders have hunted for divergence, looking for that specific moment when a technical indicator, like the relative strength index, disagrees with the price action, signaling a potential reversal. But in the era of high-frequency trading and quantitative finance, algorithmic trade divergence has evolved into a far more complex, multidimensional phenomenon. It is no longer just about lines on a chart. It is about the mathematical decoupling of correlated assets, the latency gaps between exchanges, the statistical drift of co-integrated pairs, and the subtle inconsistencies between market sentiment and market reality. Today we are going to deconstruct exactly how these algorithms work, moving from the foundational code that automates simple strategies to the cutting-edge neural networks that detect sentiment divergence in news cycles. Algorithmic trade divergence refers to any scenario where an automated system identifies a discrepancy between two or more data points that effectively should be moving in unison or according to a predictable mathematical relationship. When these relationships break, when price diverges from momentum, or when the implied volatility of an option diverges from its historical norm, algorithms strike. They do not guess. They calculate the probability of mean reversion, which is the return to normal, or momentum continuation, the breakout from normal, and they execute trades in microseconds. To build such an algorithm, one must first define the math. In the context of algorithmic trading, divergence is not an opinion. It is a measurable vector. Let us begin with the theoretical framework. The most basic form of divergence involves oscillating indicators. Regular divergence occurs when price records a higher high, but the oscillator, like an RSI or MACD, records a lower high. Mathematically, this indicates that while the asset is becoming more expensive, the momentum or speed of that buying pressure is decelerating. An algorithm detects this by calculating the slope of the price peaks and comparing it to the slope of the indicator peaks. If the slope of the price is positive, but the slope of the indicator is negative, a sell signal is generated. Conversely, hidden divergence is the inverse. If price makes a higher low in an uptrend, but the oscillator makes a lower low, it suggests the indicator is oversold relative to the price structure. Algorithms favor this because it trades with the trend rather than against it. Writing a script to detect this is harder than seeing it with the human eye, because the human eye ignores noise. An algorithm sees every jagged tick. Therefore, developers use algorithms like zigzag or swings point detection to identify local maxima and minima. The logic involves identifying the last two significant price peaks and the corresponding indicator peaks, calculating the time delta between them to ensure they are relevant, and then flagging the divergence mathematically. However, institutional algorithms care little for RSI. They focus on statistical arbitrage, or StatArb. This relies on the concept of cointegration. It is crucial to understand the difference between correlation and cointegration. Two stocks, say Coke and Pepsi, might be correlated, meaning they move up together. But cointegration is stronger. It implies a physical tether. If the spread or distance between their prices widens beyond a statistical threshold, say 2 standard deviations, the algorithm bets they will converge. Here, divergence is the residual error of a linear regression model. When that error term becomes statistically significant, the algo shorts the outperforming asset and buys the underperforming one. Then there is cross-venue or spatial divergence. This is the domain of arbitrage. If gold futures on the COMEX exchange trade at $2,000.50, and the same contract on the ICE exchange trades at $2,000.40, there is a spatial divergence of 10 cents. This divergence exists only for milliseconds. Algorithms competing here do not rely on complex math, but on pure speed. It is a race to zero, where divergence is essentially a measure of market fragmentation. Once the type of divergence is identified, the strategy defines how the bot executes the trade. Most divergence strategies assume that what goes up must come down relative to a mean. This utilizes the Ornstein-Uhlenbeck process. This is the standard differential equation used to model mean reverting prices. It mathematically defines how strongly a price is pulled back to its average. Algorithms calculate the half-life of a divergence, which is how long it typically takes for the price to return halfway to the mean. If the half-life is 4 hours, and the algo is holding a position for 2 days, the model is broken. The algorithm converts the price spread into a z-score, which represents the number of standard deviations from the mean. A typical entry trigger might be when the z-score is greater than 2. The exit occurs when the z-score drops below 0.5. However, a stop loss is critical. If the z-score exceeds 4, it indicates the divergence is not noise, but a fundamental breakdown of the relationship. Not all divergence leads to reversion. Sometimes, divergence precedes a massive breakout. This is momentum divergence. For example, volatility divergence occurs if price is flat or consolidating, but the Bollinger bandwidth or implied volatility is rising. This is a divergence between price action, which is calm, and market expectation, which is anxious. Algorithms use this to enter straddle positions, betting on a violent move in any direction. There is also volume-price divergence. If price is rising but volume is dropping, traditional theory says reversal. However, modern algos look for on-balance volume divergence. If price is flat, but on-balance volume is skyrocketing, it means smart money is accumulating silently. The algo buys before the price breakout. Perhaps the most controversial form is latency arbitrage or time travel divergence. It exploits the time it takes for a price update to travel physically between locations, like Chicago to New York. High-frequency firms place microwave towers, which are faster than fiber optics, to receive a price change from one exchange milliseconds before it hits another. For those few microseconds, the price on the second exchange is divergent from the true market price. The algorithm snipes the stale orders, effectively gaining risk-free profit. Building a divergence algorithm requires a sophisticated tech stack. It is not enough to just write Python code. For example, standard correlation fails when two assets move in the same pattern but at different speeds. The solution is dynamic time warping. This is an algorithm originally used for speech recognition. It warps the time axis to align two sequences. An algo using dynamic time warping can recognize that a head and shoulders pattern on a 15-minute chart is mathematically identical to a distorted one on a 1-hour chart. It allows the bot to detect divergence patterns that are structurally similar but temporally shifted. To handle false signals, traders use machine learning. A major issue with simple RSI divergence is the false positive. In a strong trend, indicators can show divergence for days while price continues to move. Traders use supervised learning, such as random forests or XGBoost, feeding the model thousands of historical signals labeled as success or failure. The model learns that divergence is only profitable if specific conditions are met, such as high volatility or declining volume. This hybrid approach acts as a filter, significantly increasing the Sharpe ratio. Deep learning, specifically long short-term memory networks, takes this further. Instead of reacting to divergence, these networks try to predict what the indicator will be in the future. If the network predicts the RSI will drop, but the price model predicts a rise, the algo identifies a future divergence before it even forms on the chart. The rise of cryptocurrency and decentralized finance has introduced entirely new categories. Oracle divergence arbitrage is a prime example. DeFi protocols use oracles like Chainlink to get price data, but these update on a heartbeat, causing a lag compared to centralized exchanges. If Bitcoin crashes instantly on an exchange, the DeFi oracle might still show the higher price for a few minutes. Bots detect this divergence instantly and can execute arbitrage or liquidations based on the stale data. There is also on-chain versus price divergence. Blockchain transparency allows algos to see insider moves. If the price of Ethereum is rising but on-chain analysis shows massive inflows of ETH into exchanges, suggesting selling intent, there is a flow price divergence. Similarly, if price is dropping, but the number of wallets holding large amounts is increasing, this is accumulation divergence. Finally, we have sentiment divergence, analyzed using large language models. An algo scans thousands of news headlines to compute a sentiment score. If a company releases bad news and the sentiment score is negative, but the stock price finishes the day positive, this is a bullish sentiment divergence. It implies the market has already priced in the bad news or is irrationally bullish. However, divergence trading is a battlefield filled with risks. The cardinal sin of algo development is look-ahead bias. When backtesting, if the code uses data from the future, such as the high of the day, to define a divergence point before it happened, the results will be fake. Testing must be event-driven, walking through data tick by tick. Another risk is the breakdown of correlation in statistical arbitrage. A regime change can occur where two assets that usually move together permanently separate due to fundamental news. StatR bots must have hard bailout logic to avoid holding a losing position forever. There are also adversarial algorithms. Predatory algorithms exist solely to exploit divergence bots. They might engage in spoofing, placing massive sell walls to trigger bearish divergence signals on smaller bots, only to pull the wall and buy the dip once the smaller bots have shorted. As we look to the future, quantum computing may allow for the calculation of arbitrage paths across thousands of assets simultaneously, finding divergence in multidimensional vector space that classical computers cannot see. AI agents will likely begin to trade concept divergence, understanding that the narrative of a market is diverging from its fundamentals. For the aspiring quant, the lesson is clear. The profit is not in the consensus, it is in the disagreement. Find where the data contradicts the price, verify it with code, and you have found your edge.